Non-accredited investors, IRA club members who have been driving me crazy. Ramis, please show us some more non-accredited investment opportunities. Lauren, for those of you that are joining us for the first time, can you please give a quick definition of what the difference is between accredited and non-accredited?
Yeah, great question. So most accredited means that you have to have a specific income, hold specific licenses like FINRA licenses to manage securities, or you have to have a total net worth of $1 million, excluding your primary residence. Those income thresholds are 200,000 a year for single incomes or 300,000 a year for joint income. So that is considered accredited. And that just allows you to invest in a wider variety of alternatives. We'll talk about it a little bit later, but mostly Reg D is probably what you would be familiar with if you're accredited. Reg A is open to both accredited and non-accredited. And I'll talk about why 70 went down this path, who I am, and why I have the ability to speak to you or authority to speak to you today. So you can get to know me, our story, and more about the Reg A and how that really makes something accessible and available to the masses.
So, Lauren, as you were talking, I definitely got some technical issues. For some reason or another, it will not let me share my screen. I have no idea why this is happening. So, not that I need it, but let me get this completely out of the way. Our disclaimer, all right? For those, again, that are joining us for the first time, because I know that about 95% of the individuals that are on here are IRA Club clients. We do these webinars to help educate our clients and our members and our students on different types of alternative investments, whether it is, again, bonds, syndications, houses on 123 Green Street, mobile homes, oil and gas, life settlements. We basically give you a whole array of different types of discussions, topics that we go over. Lauren is here to discuss a specific type of strategy, right? Note investing.
You have your disclaimers. We also have ours. My name is Lauren Wells. I am the co-founder at CWS Investments. We are a real estate investment firm. Some disclaimers here. This is nothing I talk about today is, investment advice. Always do your own due diligence. We, like Ramis said, he did a background check on us and did his due diligence. We work with a lot of brokers who have also done background checks. So when people ask us if they can do a background check on us, we're like, why not? Everyone else has. So again, please do your own due diligence. And this is educational and not meant to be any investment advice. So with that,
Lauren, I do apologize. My whole screen just completely froze. I have no idea why that is, but are you still able to the rest of everyone that's joining us? I hope I'm not pulling you out of your presentation. I hope everybody could still see it, but again, my screen completely froze and I'm trying to figure out why that happened.
Yeah.
We're good to go. I think you're fine.
Okay.
So
I can't see the comments right now, but if someone, yeah, here we go. Here's a Q&A. I can pull that Q&A up.
Awesome.
If someone wants to drop in the Q&A or the chat, if you can see us, that would be awesome.
No, go ahead.
So, okay, good. Someone gave a thumbs up. I love that.
Good. Awesome.
Okay, cool. So, a little bit about us. What I'm going to talk about today is really who am I? What's my backstory? How did I get involved in mortgage notes, which is probably you're thinking really obscure, as it kind of is a very random asset class. Who is 70? What is mortgage note investing? And then some frequently asked questions and some Q&A that I get that I hear all the time from investors. So to kind of start off, 70 is a mortgage note investment firm. We have a combined 7 decades of real estate experience, and we specialize in what I like to say is fixing and flipping residential mortgage notes. And I say this because most people are really familiar with the concept of fixing and flipping. Now, a resident, like a home, we do that same thing, except for we do that with the actual mortgages. So I'll talk about that a little bit later, and I'll kind of walk you guys through what that process looks like. So who am I? What is our backstory here at 70? So Chris is our CEO. I am the co-founder of 70, and both of us actually came from very similar but different paths. Chris had been in real estate development for about 25 years before he stumbled across mortgage notes and started building his own portfolio and doing some joint ventures. I actually graduated from college and played collegiate water polo. I actually volunteer coached at a high school, and this is important, I promise you. And as I was volunteer coaching, I actually looked around at the stands and I saw these parents who were able to be here in the middle of the workday on always at the games, always at the events. And what I realized is most of them, about 90%, as I kind of did my little, uh, due diligence, was most of them either own their own business or invested in real estate. So I decided I wanted to invest in real estate. I actually then got a corporate job, software sales, and used my commissions to actually fund my real estate investments. I started by networking, sitting on the other side of the screen where you are right now, attending all the webinars I could get my hands on, attending local real estate investment clubs, and I landed on mortgage notes. It appealed to me, because it was secured by physical real estate, the loan to value, is something I could really control and look at when I was doing my due diligence. And I didn't have to be a landlord. I didn't have to deal with any tenant problems. I just assumed the position of a bank. So I built my own portfolio here. And what I realized along the way is not everyone has the availability or accessibility to access funds that allow you to invest in assets like mortgage notes. Chris and I had actually met at a conference and we started partnering together on some funds and joint ventures. We did over 200 joint venture deals. That's one-on-one transactions with individual investors, and realized a majority of these people were not accredited, but had money to invest and wanted to invest in something that was real estate adjacent, I will say. And that kind of sparked us to launch the Reg A offering. And what that does is it allows us, we are qualified by the SEC. So when you think of offerings, there's Reg D and Reg A. Reg D is you submit a piece of paper to the SEC and they say, great, go for it, raise your capital, invest, and do your thing. Reg A is a much heavier lift on the sponsor's end. We have to submit basically what looks like the back of a pill bottle with every single disclaimer that could go wrong in the case of Armageddon. And the SEC reviews it. They send comments back. They want us to change language. That process is arduous and takes anywhere from, 1 to 6 months, could take 12. Now, Chris and I are, again, coming to this world as non-accredited initially. We're really passionate about making something that was available and accessible to everyone. So we went down the Reg A route and launched our Reg A in July of 2022. We are now allowed and qualified by the SEC to raise funds from both accredited and non-accredited investors. Basically, anyone can invest in our offering. And not only
Lauren, Lauren, I didn't mean to cut you off. I just want IRA Club clients to realize how hard it is to get a Reg A. They are, honestly, at this point in stage of the game, they're damn near impossible to get. I mean, and Lauren, any reasons why in particular, since you guys actually have a Reg A, what's the reasoning behind why is it so hard for non-accredited investors to get involved, or for any company to get a Reg A, better yet?
Yeah, so really, if you think of the job of the SEC, it's to protect investors. And when they set those accreditation standards, they're saying, if you're not accredited, our job is to protect you from falling victim to a scam. You can think FTX, for example. So when we were qualified, it was already an arduous process, but since we've been qualified and things have kind of gone crazy with crypto, the SEC has really clamped down on who they're allowing to have a Reg A and really solicit anyone who wants to invest. So again, their job is really to protect the investor. And so that's why it is such an arduous process, because they're basically putting their stamp of approval on this offering and the people behind it as well. So all the things, background checks and everything.
And for those just to give it to you in better perspective, for those of you that are listening, that are IRA Club clients, there are hundreds of thousands of 506Bs, Cs, also we refer to them as the Reg Ds, across the country. Reg As, I think it's like less than 3,000. Okay. So that just shows you how hard it is to get one of these and why I fight so hard to find them when I go to events, when I do background checks. But some of them do not make sense for retirement accounts. This is the reason why I'm super excited when Lauren starts talking about this Reg A. It's got a different investment strategy, number one. Number two, Lauren, and this is something that you'll be proud of. We actually here at the IRA Club learn a lot from our own investors. Note investing has really taken off the last, I would say, 6 months,
Yeah.
only because it's very hard to find real estate deals right now because interest rates are really high. I think that notes have exploded in general. And the fact that you have this for non-accredited investors, let me just say on behalf of the IRA Club clients, thank you. And let's give Lauren and her team a thumbs up for getting a Reg A for you to actually make that investment. So thanks again, Lauren.
Awesome. Thanks. So not only do we get the Reg A, but when we crafted it from the not position of investors ourselves. Things that drove us nuts about investing in other funds. And I'll talk about that a little bit later. But one of those main things was really the barrier to entry. So not only did you have to be accredited, but say you were accredited and this was your first alternative investment or, non-stock bond or mutual fund, they wanted a 50K minimum, 100K minimum. That's a lot to cough over for your first investment. It's a lot of trust to place in one person if you've never done an alternative. So not only did we make it a Reg A for the, like availability to everyone aspect, but we also, our minimum investment is 5,000. So it was really this passion behind available and accessible to the masses. So that's a little bit about our backstory and kind of how we got here. But now I want to dive into mortgage notes a little bit. So mortgage note industry, like Ramesh just said, it is massive and it's taking off. So for example, and this is a little dated, it's about a $16 trillion industry at this point in single family residential debt. I'm not talking commercial or multifamily, just residential debt, with anywhere from about 200 to 500 billion dollars in single family non-performing debt. Now, non-performing, I'll talk about here in a moment, but to back up a little bit, if you're listening right now and you're like notes, mortgages, mortgage note, we use them interchangeably, but they are not. If you have ever owned a home or purchased a home, you are actually signing two documents, a note and a mortgage. The note is the terms, the promise to pay, the agreement from the borrower and the lender, typically a bank. And you're going to pay $100,000 over this many years at this interest rate. It's your IOU, and that it's secured by the physical property, that house that you're purchasing. Now, the mortgage is actually the legal document that secures the property to the note. So you're signing both of those, and that mortgage gives the lender, the bank, or whoever the lender is, the right to collect using the property as collateral. So that's why, maybe it was just me, but when I grew up, it was like, if you don't pay your mortgage, the bank is coming and they're taking your home. So that's kind of the process there and what mortgage and a note are. Now, mortgage note investing is a investment strategy that is secured by physical real estate. In our case at 7E, that's single family homes. You could do this on commercial, multifamily, again, for us specifically, single family homes, it's kind of our specialty. So note investors buy loans from private lenders, credit unions, hedge funds, banks, or whole loan traders who basically work with banks to send out assets that are for sale. You are typically buying these at a discount because either they're in default or the current lender wants to get them off their books. And I'll talk a little bit about why that might be later. And then as the note holder, what you're doing is you're basically assuming the position of the bank. You're, buying the rights to the future mortgage payments and the right to repayment according to the terms of the note. So again, you're secured by that physical real estate. You're assuming the position of the bank is probably the easiest way to state it. Now, to give an example, and if you've owned a home or you're sitting here listening, if you've ever purchased a home and then a few months later received a letter in the mail saying, hey, your loan has been sold from JP Morgan Chase to Bank of America. Please send your future payments here. That is an example of a note being sold. Notes, if held for 30 years, The average amount of time they'd be sold is 7. So banks are constantly selling loans, and there's multiple reasons that they could be doing that. Now, there's 2 types we talk about notes. There's performing and non-performing. So performing is, a borrower is paying their mortgage per the terms of their agreement on time every month. Non-performing is when a borrower has failed to meet they're behind. They're in default 90 days or more. So you can miss 2 months and be considered performing still. It's really after that 90-day mark that you're non-performing. And you can see these are typically purchased at a discount. Performing is anywhere from 60 to 90% of the outstanding balance. So if it's a $100,000 loan, you're going to pay $60,000 for it. Non-performing is anywhere from 40 to 60% of the outstanding loan balance. So those are obviously discounted more because they are in distress. Now, this is that whole fix and flip process. Buying loans on a single family home at a discount. So that's the discount. You're getting the discount on the loan. That's the purchasing, like you would purchase a home that's in really bad shape at a discount because the seller knows you need to fix it up. So at 70, we focus on non-performing. And so we're buying these at a discount, again, anywhere from 40 to 60%. And then there's really kind of 2 routes you can see here. You're either going the top route, which for us is about 90% of our portfolio, and that's really negotiating a payment schedule with the borrower. Now, common misconception is that people wake up one day and say, hey, I'm not going to pay my mortgage. This is the month. When in reality, when we do our due diligence, it's really they fell upon some sort of job loss, health, divorce, death, some life incident that caused them to get behind. And then when they go back to the bank to try to make payments, banks are super inflexible. So if you're behind 30K and you go to the bank and say, I can make my monthly, they'll say, that's great, but we're going to apply that to your past due and late fees. And it becomes kind of a snowball. So what we do is we negotiate with them a payment schedule, get them caught up, do what's called a 6-month trial payment plan, where we're generating cash flow from those payments. And then once we have 6 months, we will basically recast or modify the loan, extend the term. They'll make monthly or quarterly payment plans towards their arrears, and we'll hold that for about another 12 months. And then which takes the value from non-performing to performing, which increases the value, and we sell it back on the secondary market. So we're either selling it as performing after buying it non-performing, so that fix to flip. The borrower can also sell their home or refinance and the loan is paid off. Both of those are happening less now. Obviously, as interest rates increase, most people are choosing to kind of work with us. And then for about, again, that's 90% of our portfolio. And then taking ownership of the home is if a borrower decides, hey, I'm not going to work with you, then we can go that foreclosure route and we'll either take back the property or do some sort of cash for keys. Typically, we don't take back the property, though. As you can imagine, properties are sold at auction. Investors are going to show up, pay all cash. We are paid off in full. So for example, if we purchased a $100,000 note for $50,000 and put about 10K of legal fees that are recoverable into it, we're actually going to get the full payoff, which would be 100 plus the 10K in recoverable legal fees. So at auction, our opening bid on this asset would be 110. And so that would be a payoff that we would receive. Now, you might be thinking, okay, so you just bid on these assets and then you acquire them and that's it. It's actually more like buying a home. You give your preliminary bid based on what's called a tape, which is basically a glorified Excel spreadsheet of assets. The seller can then counter, accept, or reject. And then once they accept those indicative bids, you enter a due diligence period, similar to escrow on a home. Once the seller accepts your offer, you enter a escrow period. That can be anywhere from 4 to 6 weeks, sometimes shorter if it's only a few assets. And there's where we do our deep dive. And so that's where we're looking into the 3 Ps, which I'll talk about next. But we're doing a deep dive into everything on the property, the person, the predicament, and finding if trust but verify. We're trusting the seller's information is accurate, but we're verifying with our own, people that put eyes on the house. We're looking at legal documents, and there we're able to say, okay, our bids align with what the data that was given, or we found something that makes us want to fade our bid either the value doesn't align, it's a second position lien versus a first position. And then once we come to an agreement, we then close on the assets and board them. Now, someone asked a question, and I always like to answer questions as they come, so keep them coming. How often after modifying a note do you have to foreclose? We actually don't foreclose. If we've modified the loan, then our goal is to get that borrower reperforming. So we don't foreclose unless we have to, unless the borrower says, I'm not going to work with you. I am no way I'm making another payment. And our due diligence process is what really mitigates that. And I'll talk about why here now. So when we go through our due diligence process, not only do we, before we even place bids, have, a proprietary calculator that calculates, what we should be bidding. And we have a team that goes back and forth, saying like, yes, no, and a whole bunch of checks and balances there. But then in our due diligence period, after that indicative bid is sent, we actually look at the property. We get eyes on the property. We validate and confirm the value that the seller gave was correct. We make sure it's first position. We make sure title is clear. It's in structural good condition. I don't know how many times I've heard of people investing in a note where they didn't get eyes on the property and the property was in totally rundown shape, or worst case, not a property, it had burned down, or it was actually just land. Then we also look at the person. We make sure that there's no criminal history. We look at their financial history. We look at their mortgage payment history. We make sure with our attorneys that, again, is the borrower the actual person on title? Is the mortgage been assigned to them at the county level? So we're looking at legal aspects of, is this recoverable? Is this the right borrower? Again, a lot of little things that are super nuanced, but very important to our process. And then lastly, and this is where something that kind of differentiates us, is we look at the predicament. So a lot of lenders will overlook this if they're taking on a note, and we look at prior servicing notes. So servicers are the ones who are actually collecting the payments. In most states, you have to have a mortgage license or a debt collector's license, to collect them. So like we have a servicing company that collects the payments on our behalf, and servicing companies are gems. They have all the awesome data on and notes of why the borrower fell behind, any communication they've had with the borrower, so we're able to ascertain a lot about the borrower's ability and desire to get back on track. Sometimes we'll see that the borrower actually tried to reach out to the lender. And one thing that's really important to note is banks are great at creating debt. They're awful at managing it. If you're not performing, paying as is, they don't know what to do. So I think I'll talk about a case study later where it was just a communication ball dropped by the lender. The borrower actually reached out to get performing and get back on track, and the lender didn't get back to them. So that was an easy win for us. And that's something about our in-house team that's really important. We're able to move through this process very quickly because we have an in-house team that is open communication on top of it. Now,
Lauren, somebody just asked a quick question. I know you like to ask them. A couple of housekeeping rules, as I had some technical issues, and many of you just met Xavier. If you can, put your questions inside the Q&A. If it is a private question, which I know a lot of you like doing, you guys will send a direct message to me and or Lauren. Please feel free to do so. A gentleman named Al asks, would we be investing in a fund for diversity and not the individual note? So
great question. So that leads me into this. So what I talked about was I started as an individual investor. That is definitely an option. It's available. I wanted to give some context around what goes into that. However, there's also the passive option, and that is a mortgage note fund. And like you mentioned, it allows for versatility. Not only are you mitigating risk because you're investing in a portfolio of assets rather than a single asset, but within mortgage notes, something that drew me to it was there's so many exit options. You're not tied to, we have to refi, cash out, and, kind of like the BRR method. So I like that numerous exit strategies aimed at making a profit. It's collateralized by physical real estate. A lot of people want to invest in real estate. It is very hard, like was mentioned earlier, to buy a property these days. Interest rates are out of control. The numbers just don't work. So unlike stocks that are backed by very little collateral and have high volatility, the notes are less volatile and they're secured by physical property. So profitability and varied market conditions. I have a whole slide on how it performs in this economic environment, but note prices in the marketplace really function in relation to supply and demand. So during COVID, what we saw was a huge increase in values. And so less people were selling, there was less inventory out there, and the inventory that was out there, because there was less, created a higher purchase price. Now, as you may or may not be noticing, we are seeing record credit card debt and default, auto loan default, and right behind that comes mortgage default. So to kind of give you an example of what we've seen in terms of inventory, in Q1 of last year, we were looking about 300 million in the first quarter to bid on. Q2, 300 million a month. And since Q3 and Q4, it's been about 300 million to 400 million a week in assets to bid on and acquire. So inventory has ticked up. And then really a mortgage note fund is if you want to be a passive investor, you don't want to be doing all the due diligence, making sure you have the attorneys, the servicing, everyone kind of, you want to, basically your job as a passive investor is to assess me, Chris, my team, our process, our, how we do things, what's our track record. You're investing and putting your faith in the team and letting them manage the assets and portfolio, and investors are entitled to, depending on how the fund is set up, dividends, quarterly payments, a K1, profit only. So different options depending on how the fund is set up. So a little bit about us. We've done over 600 individual fix and flips. We've had 5 funds go full cycle. We've been invested in across 40 states, and we have a vertically integrated team. And I don't think people highlight that enough. And I think how you found us is testament to that. We have an integrated IR team who is speaking with investors. We have an integrated asset management team, an acquisition team. We've looked at vendors, we've looked at partnering, and honestly, maybe it's because we're all type A control freaks and we want to make sure that our investors are taken care of. We have over 500 investors now, and I like knowing as one of the founders that when someone emails, they know they're going to get something from Tony, they're going to get something from Katie, they're going to, they're going to receive a response, and they're never going to be left in the dark. The communication is there. We send out annual investor feedback surveys because we want to know where we can improve. Again, that is something that's super important to us, not only on the investor side, but on the acquisition side. We can move so much faster because we're not outsourcing to an asset management company that, it's not really their baby. This is our baby. We want to make sure that things are getting done quickly and expediently because we only win if our investors win. So, and then historically, we have never missed a distribution or lost an investor's principal. Again, past performance is not indicative of future results. Total disclaimer there. But I think it's really about having had 5 Reg D funds go full cycle before this Reg A. Did we do what we said we were going to do and follow through on that? And we have. So I think that's important. So I'll give you an example of kind of what a Reg A could look like. So this is one of our example of our current offering that we have. Again, offering open to accredited and non-accredited investors. Things you'll want to look at when I always like talking about not only, offerings we have, but like as an investor myself, what are some things I look for, ask, think about? So the term on this offering is 4 years. Minimum investment is $5,000, but we do offer bonus shares starting at 25. And then the preferred dividend. So like, what am I getting back? And how is that paid? So 8% on this fund, anywhere from 8 to really 10, depending on investment amount, because those bonus shares do add in additional preferred dividend. So things to think about as an investor, can I invest with my IRA? I would not be speaking on this panel if you could not. So it is open to qualified and non-qualified accounts. Dividends, they are dividends paid monthly. So you think about today, what are people worried about? And this is really an income play. People are worried about, can I retire? Do I have enough money to retire? A large part of our investor kind of base, I would say in the beginning, was a lot of people who were nearing retirement, in retirement. But what's cool with the Reg A, and because I'm a mom of 2 boys who pays for daycare, Um, it's people are coming to either subsidize their current lifestyle because of inflation. They're like, I want to be able to invest my money and pay for my car payment, my offset my mortgage, daycare costs, whatever it might be. So it's cool for people to get started and see kind of how they can make their money work for them. So this is that dividends paid monthly. Um, Equity coverage in this environment, super important. You see a lot of people who invested in asset classes that, were hoping interest rates would stay low, and they over leveraged themselves. And now investors or sponsors are having trouble, keeping those dividends paid because they couldn't refi at the rate they thought. So with our asset class, something that's really important for us is we don't take on additional leverage. Like, investors are really first in the capital stack, meaning if Armageddon hits or something goes wrong, investors are paid first before us, so investors are paid first. And then loan to value. Every time we look at assets to acquire, that is probably the number one thing we look at. Not only is it a first position and is it in states we do business in, those are easy, but is there a loan to value that makes sense for us? So if the housing market drops, are we still covered? Are our assets able to be recoverable? And so we have up to 4 times collateral coverage. I think on our portfolio right now, it's about a 30% LTV, which is very low to give, very low. So it's not a blind pool. We have over 93 assets in our portfolio. As an investor, I think that's important because I want to know that this is something that they've been doing, they're currently doing. They're not, waiting on my funds to acquire something. And what if they don't raise all the capital needed? So it's not a blind pool. Fees. Oh my goodness. We don't have any fees, but this is something that as an investor, when I started out, drove me nuts. You see, oh, I'm going to get 10% return, 11% return. And then there's an acquisition fee, a management fee, an account fee, and you're going to get a K1. So your return is actually 6%. Well, shoot, right now I could put that in a high yield savings account and get 5. So important to look at the fees. Ours doesn't have any fees currently. And then the tax ramification. Obviously go ahead.
Lauren, somebody in the private chat goes, well, how do they make money? So
Yeah, I know. Yes. So we don't have management fees. We set it up so that we make upside. This is an income play. So our investors are getting anywhere from 8 to 10%. Anything above that goes to the fund sponsors. So again, that's why I said we win if our investors win. So, and then taxes, 1099 dividend doesn't really apply to qualified accounts, but if you're investing with cash, that does make a difference. You don't have to worry about the K1s. And because we don't take leverage, there is no UBTI. I always say UBIT, but I know it's UBTI.
yeah, UBIT, UDFI, yes.
Yeah, UDFI. So that
Yeah.
doesn't apply.
And I'm so happy that you brought that up, Lauren. Yes, you do not trigger UBIT or UDFI. And I love the fact that you said to the individuals, I know that we're dealing with retirement dollars, but remember, I told you when I host somebody who we're talking about alternatives, remember partnering, even though this is such a lower barrier to entry of $5,000, remember you could use your personal dollars and your retirement dollars with any one of these companies, right? So, or you could partner. Always remember partner. Lauren, somebody just also asked me, can a minor Roth IRA account invest in this? I'm just wondering.
No, that's a great question. So you can invest on their behalf. You would have to bear the tax burden though until they're 18. So I don't actually know how that would work with a retirement account. We haven't had anyone do that. With a cash account, we had someone set up a cash account for their kid. They invested, their name was on the stock, but as far as taxes, they're paying the taxes. So I don't know necessarily how that would work with a qualified account. I don't know.
Well, Lauren, if you don't mind me, if as a favor to me, not just to all the IRA Club clients that are listening, because I'm a huge advocate of youth accounts, minor accounts, getting your kids started early, grandkids. Let me know if a minor account, so if somebody has a Roth IRA, and can they invest in your deals? That would be a great, for us and our clients to know that.
Awesome. So I see some other questions.
Yep.
We have 10 employees. We're headquartered in Virginia. and 10 internal employees. And then we have our servicing company that we use to service the loans, again, because we are not licensed debt collectors. And ever since COVID, the CFPB, which always sounds like a crazy Marvel's Avenger group, which really stands for the Consumer Financial Protection Bureau, they really used to be able to service your own notes. And then once COVID hit and the restrictions came up, and the government intervention was trying to protect borrowers from who had issues because of COVID, they really made it so that you have to be a licensed servicer in order to collect it. So really important that if you decide to do this on your own, that you find a licensed servicer to partner with. Someone asked about what is the size of your note portfolio? What is the collection rate of your note portfolio? So right now we have just under 100 assets. We had at max 150, but like I said, this fund has been open for a bit. It is what is considered an evergreen fund. So there is no exit date at the end of your lockup period or those 4 years. You basically can then request redemption. So also important to note. So again, we have right now just under 100. At our max, we had about 150, but we have sold, because we've made them performing, quite a few assets. So the typical hold time is anywhere from 18 to 24 months. So about in a 4-year period, we hope to flip them twice, flip a note twice. I think we already answered those other two.
Yeah. Yeah. How many employees? I was about to say, I think you answered that. And then tax-free with a Roth, that is correct. A rollover, no. That's most of them are within the traditional sense. If you have, for example, old employer 401k, I would probably say about 94% of those are traditional, rollover to a traditional IRA. So hope that answers your questions. Somebody actually asked me also in the chat, is there a penalty if we pull out our money earlier?
Great question. Love that. So we do have what's called a death and disability put. So in the case of death or disability, there is no penalty for early redemption. There are redemption penalties should you withdraw. They start at 12% in year 1 and 5% in year 4. So kind of go down based on at what point you need to redeem. And that's on the principal investment only. These are some probably of the most frequently asked questions. So I kind of want to go through this, and it was hard not to talk about them in the moment, but so why would banks sell? So we saw Silicon Valley Bank. I kind of use that as my example. There was that run on the bank. They had a ton of loans at 3%. They were losing money. So banks are looking to be liquid right now, especially in this economic environment. So banks will sell either because they're trying to rebalance their portfolio. They're losing money on a 3% loan, even if it's paying. They can say, okay, wait, I can sell this for a discount and then rewrite paper at 8%, and I'm making money even if I had to sell it for a loss. So a lot of banks are doing that, offloading performing, non-performing. Again, kind of going back to that, philosophy of banks are great at their job is to create debt. It is not to manage it. So when they have a ton of non-performing on their books, kind of the same thing. It'll take them significantly longer to work through that foreclosure or work through that workout process. So their kind of thought process is, if I sell this, again, it may be at a discount, but if it takes me 2 to 3 to 4 years to move through this as a foreclosure, I'm going to be losing a lot more money and not receiving any payments. If I sell it for 50% discount, again, I can go write new good paper at 8%. So that's kind of some of the reasons. And then like we sell, other lenders will sell to, if their fund is closing, they want more liquidity, assets may not fit their buy box, or they're also looking to rebalance their portfolio. I get this question a lot because I think when people hear mortgage notes, they have PTSD around 2008. So very different from 2008. 2008 was really lender induced. Those were bad loans, and there was a ton of inventory. So people were fine and dandy walking away from their mortgage, filing for bankruptcy, and going to rent down the street for next to nothing. Now what we're seeing is we are seeing tons of mortgage defaults, but there's no inventory in housing, and rental rates are through the roof. So when I say 90% of our borrowers are incentivized to work with us and want to, it's because they're looking at their rate. Maybe it's even 5%, but it was talking about the vintage of the loans. We're not looking at things that were originated in the last few years. We don't originate loans. We're buying loans that are, anywhere from 10 plus years old. So anywhere from 2000 to 2013, I would say would be our sweet spot. So these are loans that are seasoned. These people have paid down their loans and they're thinking, okay, I have a 3-bedroom, 2-bath house. I'm paying $2,000 a month for, or I can go try to rent a 1-bedroom, 1-bath apartment for $2,500 a month if I can even find something. So typically they're incentivized to work with us and come to some sort of agreement where they can stay in their home. Again, because it really benefits them most.
To be full disclosure, 7E is the newest company on Investors Row. Thanks for the thumbs up, guys. And thanks, Lauren, for that great presentation. Once you go, there's strategy, obviously, which we talked about, but this is all about networking too, okay? Reach out to the 7E team members, okay? Schedule a call with Tony. She will walk you through any questions that you have, but the actual investment opportunity lives on Investors Row, where you could pledge to the investment. It's going to give you a description. Obviously, we know it's a note, minimum investment, targeted rate of return, monthly distributions. And here is the fact sheet or the track record. Please correct me if I'm wrong, Lauren. It's right over here where they could download that.
Yeah, so the fact sheet will be basically the terms and a little bit like highlight about how we fix and flip. You have the sub agreement if you want to look at it. And then the track record, I think that's a bonus. And I think it's something I would never not ask for again as an investor. Myself is a third party did a track record verification, making sure that our past funds were calculated correctly. How do we calculate IRR? Did we return all our funds to our investors? So it's basically like a opinion letter of a third party firm who audited that.
Awesome. This gets great. And then I absolutely love that you guys did this. So here's an actual video that you guys can watch about how to make the investment straight from their platform. So remember, when you actually are, remember, 95% of you are current IRA Club members. So remember, you have to pledge to the investment first. So many of you are not as familiar with Delmore's platform because we do work with Dealmaker and Frimidium. So remember, you have to be an IRA Club client first in order to use your retirement account to invest with 7E. Okay. By executing this form, this is our disclaimer. You have done your due diligence. IRA Club is not making this investment for you. You're basically doing this of your own free will. This is a streamlined process. That is the whole focus of this, and it will take you to the video that Lauren was just discussing or showing you on her current slide. And then you guys would go through this process. If you have an issue or problem, what do? You go back to their landing page and schedule a call, and they're more than happy to walk you through that process. IRA Club clients, to thank you again for your time. I hope you love these. You're educational based as much as we could do these and as often as we could do these with time bearing. Lauren, it is again a pleasure. Thank you again, love. And say hi to the rest of the team at 7E. You guys all do a fantastic job in communicating and just getting the word out. Thank you again. Everybody have a great rest of your day.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.